All right, let's kickstart the Money Show then. And our very first guest for today's episode is Mohit Gang of Money Front. Mohit, hi, good evening, and thank you so much for taking our time and joining us today on the Money Show. So Mohit, debt fund as a category has not done that well this year in 2021. Last year we saw superb returns by long duration funds, especially, in fact, and we've been seeing gilt funds as well do extremely well. But so far this year, we've seen a bit of a faltering by debt funds. Liquid funds as well have not really been up to the mark. To start with, and before we delve into the nitty-gritties and the different categories, what do you think is the reason for the lackluster performance by this category?
Hi Mubina, it's always good to be talking to you. So look, I think debt funds as a category is a direct subset of how interest rates are in the economy, right? So the way interest rates have been behaving, we are at historic lows on repo, reverse repo for almost a year now, right? So given that background and the surplus liquidity in the overall banking system, debt funds have just not been doing great. Liquid funds have been delivering around 3.75. The overall YTMs across different categories of debt funds hover between a range of around 4 to 5.5%, right? So given that scenario, it's been very difficult here for debt investors if you are looking to beat inflation, right? Because the sole goal of investing in debt funds is to beat inflation by a reasonable benchmark, say 50 bips or around 100 bips. But that's not been happening on the shorter end of the curve. On the longer side, the gilts and other funds, they've all delivered supernormal returns last year. And now the 10-year yields or the overall long duration yields have been just at a rock bottom level. So from here on, it's very difficult ride uphill for debt funds, as you've rightly pointed out.
Okay. Now, you know what? There are two funds. If I have to look at some data that, we've got from Morningstar, there are two funds that are really standing out with more than 5% of returns so far this year. One is a floating rate fund, 5.8%, and the other is the credit risk fund. So let's start talking about the floating rate fund, which seems to be giving more stable returns compared to credit risk funds, because even the bottom performer has managed to eke out, of course, a very small gain, but nevertheless a 2.5% return. So to start with, tell us what exactly is a floating rate fund?
Okay. So yeah, you're absolutely on the point out there that floating rate and credit risk funds have actually done very well for this year also. Now, floaters as an instrument is something which is linked to interest rates directly. So if your interest rates are likely to go up, floating rate will reset its interest rates basically. So the coupon in the floating rate instruments keep getting reset as per the interest rate movements technically. As per SEBI definition, 65% of the total assets of a floating rate fund are to be invested into floating rate instruments necessarily, which means 65% of your portfolio will keep getting repriced. It can get underpriced also if interest rates go down. It can get overpriced also, or it can get higher coupons if interest rates go up basically, right? But the problem in India is that you don't have actually real class floaters available, or so many floaters available in the market. There are around, if I'm not wrong, there are around 12 floating rate funds in the country with an aggregate AUM of almost around 85,000 odd crores, right? So the market is fairly high. The category has been witnessing net positive flows of late because investor interest is fairly high because it's been receiving positive flows, and the returns are also fairly handsome in the category.
Okay. So if you believe that interest rates are going to go up, then it makes sense to invest in floating rate funds. Right now, Mohit, what are you recommending your clients? Because for the longest time, in fact, I think for the last 7 to 8 meetings, interest rates have not gone up. The RBI has kept interest rates steady. And, like you as well mentioned, because of that, we've not seen debt funds do well either because, they've been on the down low. So right now, what do you think? What's the recommendation you're giving your clients for floating rate funds?
Look, Mubina, I think interest rates going up to our mind is a matter of when and not if. So rates will definitely go up, given that the bottom line indicators in the economy are looking extremely vibrant and positive right now. The economy is back on track, sectors are opening up, your inflation has been inching up. So it's a matter of time when RBI will actually start inching up rates, and that's the time when floaters will actually deliver much better returns than what it has been doing currently also. So our recommendation to clients will be, this is an extremely lucrative category. If you're looking to invest in debt funds for a tenor of around 1 to 2 years or 1 to 3 years, this category could be extremely useful in times to come.
Okay, so it's not a matter of if interest rates will go up, it's just a matter of when. Just to give you an example, this week, just how we have the RBI, the US has the Fed. The Fed is in fact holding a very important event called the Jackson Hole Symposium, and that's where a lot of macroeconomists will be looking at, will be listening into to get cues on when the Fed will not interest rate increase, but cut down on the liquidity. Many are calling it as a precursor to a hike in interest rates, but the Fed has said no, that's not the case. But nevertheless, as the globe starts improving, and let's pray and hope that there is no third wave of COVID, there is a possibility that sooner rather than later, interest rates around the world, not just in India, will increase. And in such a situation, obviously, like the floating rate fund suggests, it will go higher. And clearly, Mohit, if we have to look at the returns, I think investors are already preempting that, if you could call it that, because floating rate funds have given great returns so far.
Yeah, absolutely. So there are limited choices in the entire universe, and one has to be cognizant that the funds will have some amount of AA papers also. And plus, all instruments are not necessarily true to label floaters. So they do a lot of swaps, interest rate swaps or overnight index swaps in the scheme to maintain that 65% allocation which SEBI mandates them to do. So these are not true to label floaters, but yet the instruments will keep getting repriced. You can look at Aditya Birla Sun Life floater, ICICI floater, HDFC floater. These have been doing fairly well, and last 1 year returns have been quite attractive in this category. So yes, investors can look into this category.
Yeah, in fact, I'm seeing some data that you've shared. The ICICI approved floating interest rate fund, 7% gains in the last 1 year, 6.3 for HDFC and then 5.2 for ABSL floating rate fund. What would be the right time horizon, Mohit? Because the fact that, this is very dependent on interest rates in the economy, it's not like an equity mutual fund, right? That you buy it and then, you sit down. So what's the time horizon, the objective you should have when putting your money in a floating rate fund?
So look, most of the floating rate funds carry a duration of around 1 to 2 years between that kind of duration. And typically an investor in a debt fund ideally should match his investment duration, investment horizon to a fund's modified duration. That's a broad thumb rule of investing into a debt fund. So if you're looking for a time frame of 1 to 3 years, anywhere upwards of 1 year is actually a very good time horizon to be investing into floating rate funds.
Okay, understood. So there you have it. That's a 360 degree on floating rate funds. Now let's talk about credit risk funds. Unlike floating rate funds, this is a very volatile asset class. I'll tell you why. The average return from this category in the last 1 year has been around 5.5%. The best performing fund in this category has returned 16.6%. But the worst performing fund in this category has actually delivered a negative figure of 27.6%. So imagine the swing really between the topmost performer and the bottommost performer. There's risk in the name itself of this fund, and you know what, this fund has been through tough times as well. It has been beaten down, especially in this last 2 to 3 odd years, not even in 1 year, since before the pandemic as well. What do you think, Mohit, is sort of bringing about this recovery in credit risk funds?
Look, so there are multiple reasons, Mobina, and as Shakespeare puts it, what's in a name, right? So if you ignore the name part of it, which is credit risk itself, you can actually look at fairly handsome returns from the category if one is willing to be a little adventurous in the debt allocation of the portfolio. Now, whether one should be doing that in debt allocation is a very, very different question altogether. To my mind, going for that 1%, 1.5% higher in debt, which is meant to be providing safety and security, ideally might not be the right choice for an investor, but it will again depend from investors to investors. Now, coming back to the main question, look, credit risk funds will typically invest almost 65% of their portfolio in corporate bonds, basically. And now these corporate bonds are mostly AA plus kind of papers, and even below AA, a huge allocation, huge as in between 10 to 15 or 10 to 20 odd percent allocation also goes into single A papers in most of the portfolios. Now, if you check the yields on these papers, Today, a 5-year government paper is quoting at almost 5.69%. A 5-year AAA corporate bond is quoting at 6.1%. There's hardly any difference. But you go to a 5-year AA corporate bond, it's quoting at 9.25%. There is a 300 bips difference between a AAA and a AA corporate bond. And if you go to a single A plus paper, 5-year maturity, the yield is 10.25%. So there is massive yield catch up. There is massive yield swing between a AAA and a AA paper, and that's the reason this category has been very, very attractive. The yields are very high right now. These yields will compress. That will give additional capital appreciation in the portfolios. And even if the yields don't compress, the YTMs in the portfolios are very attractive right now for investors to get into, provided you are willing to take the credit risk on your portfolio.
You know, when things are not hunky-dory for India Inc., the risk that, you know, these companies could default, considering the fact that they are AA and below, could increase. And you have a fund that does tend to obviously hold the slightly lower rated, securities. So, Mohit, should one really in a way look at the economic cycle or the growth cycle that the country is in right now before investing in credit risk funds? Do you think that could be a good determinant on when these kind of funds could deliver good returns?
Look, Mobina, I think in investments, one thing is very common. You have to catch the lead indicators and not the lag indicators, basically. So if you're really looking for the economy to turn rosy and all good, the returns would have already been taken off the table, right? So if some has to really take risk in the debt, and I continue to repeat that phrase, that if you have to really want to take risk in debt, because there is a good amount of risk in credit risk funds out there. There is a risk of default, there is a risk of downgrade, there is a risk of delayed payments and so on and so forth. There is a lot of liquidity risk, there is a lot of duration risk also out there. So one has to be really cognizant. But if you have to take a plunge, then today is the right time when the economic indicators are about to pick up or they have already started picking up. The yields, as I showed, the difference between the AAA and a AA paper is fairly high right now in the economy. So that is the time when you really would want to capture those yields. And the category has started seeing some flashes of new inflows of late, not very high though. The category has shrinked hugely in last 3 years, but yes, some green shoots can be seen.
Okay. Now I know, everyone's risk appetite and ability to take risk varies differently, but let's say someone who has, someone who's younger can afford to take more risk. How much, Mohit, would you recommend he or she allocates to credit risk fund then, right now?
Look, in part of your debt portfolio, I don't think so it fits as a part of your debt portfolio because it's fairly high. Debt is basically to provide safety and cushion to your overall portfolio. So you'll have to consider as part of your, if not equity, but you have to consider it as part of your aggressive portfolio, for lack of better words out there, right? And one has to, I don't know whether taking an aggressive call on debt is the right strategy or not. Ideally, I would, as a personal choice, would want to go for aggression in my equity portfolio, not in my debt portfolio, right? But if someone has to take that call, 5 to 10% allocation can be justified. But one has to be really cognizant, Mobina, that the bad episodes in India have been far too many. You have had the Island FS crisis, you have had DHFL, you have had SL Group, you have had multiple other cases. And plus, COVID has dealt a body blow to the economy. So the real economy is still undergoing some pain. And you don't know the extent of defaults which can happen or extent of delayed payments which can actually happen. So one has to be really aware of these risks before making such a choice.
Exactly. I mean, that's the main thing over here, because we've seen problems even prior to COVID, and COVID, like Mohit said, has dealt quite a body blow. So it can be a little risky. Mohit, would you advise senior citizens, retired individuals to invest at all in credit risk funds, given that income, of course, at this point of time is either zero or minimal?
Not at all, Mubina. I think it's not a category for retired or senior citizens or for conservative investors at all. They should be looking at other categories of debt which are more conservative in nature, or which can give them steady returns. This is not a category for these kind of investors.
All right, great. Well, you know what? We'll take on board some questions and queries then we've received from our viewers, and let's get straight to that. Our first question, excuse excuse me, is coming from a gentleman called Kishore Kumar. He says, what's your take on the ICICI multi-asset fund dividend payment option? Your view and review. I was holding it for the last 3 years. It's given me around a 20% return. Can I hold for long, or shall I go for some other fund which you think has the potential to deliver steady returns? Well, a multi-asset fund does the job of asset allocation for you. It's got money in equity, debt, and even in gold. What do you think of this as a fund category, and also the ICICI multi-asset fund?
Oh, I think the category is quite superb for investors who don't want to do the asset diversification or a portfolio diversification by themselves. If you really want to be a self-dependent investor, want to make a safer choice, want to have diversification on your portfolio, then go for a multi-asset allocation and you are sorted, basically, right? But you have to be aware that how the play is happening in the portfolio. So per se, for this fund, there is almost 85% equity, just 10% debt, and 4 or 5 odd percent commodities, which is primarily gold, right? Now, if you go in the market and look for other multi-asset funds, they will have a slightly lesser proportion of equity, higher proportion of debt, and higher proportion of commodities also, right? So it's a personal choice. What kind of an allocation do you want to look at? You have to carefully study the allocation of each underlying fund. Because the fund has been into equities at a higher rate, it has delivered higher returns, and equities have gone through massive rally, as we have all seen, right? So there's nothing wrong about the fund. It's a great fund, doing very well. The investor could actually shift from dividend option to growth option because dividend is now completely taxable, but he can continue to hold the scheme.
Well, I think that's all the time we have to take on board questions and queries. We let you go on that note. Mohit, thank you so much for joining us this evening on The Money Show.
My pleasure. Thank you.
Yeah.